We are good to start. Yeah. If you could move yourself a little bit there, so that we have the.
Oh, I'm sorry. Yeah.
You're welcome. Hello, Bekus.
All right, we are going to get started in this little family living room session in the world's tiniest pavilion at COP29. But our
It's the standard size.
The standard size pavilion from our very kind hosts, Lorcha and the other sponsors of the Digital Innovation Pavilion. Thank you. My name is Krista. I'm the co-founder of ClimateAligned, also senior advisor to the Climate Bonds Initiative. I'm delighted to be hosting this panel discussion today with a very esteemed group of panelists who actually don't need introductions in their own right, but I will, because I'm feeling magnanimous, let them introduce themselves in a moment. We're going to be talking about how to channel more money into emerging markets, which is obviously the discussion of the day at COP29 as well, the Finance COP as it's branded. We have different perspectives on this topic from investor, bank, standard setter, and service provider point of view, and from a technology company. I'll frame this a little bit by saying we're also releasing today a white paper that looks at how on earth you can extract 55,000 SDG related indicators from the annual and sustainability reports of about 270 companies using AI in a way that actually makes sense. And you can start to have a more data-driven and informed discussion about whether there is actually data that investors and banks and others can use to understand where the gaps are and how we should further engage EM issuers of bonds and equities in this race to get to a climate resilient world. This paper uses the impact disclosure guidance from the Impact Disclosure Task Force, of which JP Morgan is a co-chair, and I'll let Aras talk a little bit more about that in a moment. But I would obviously encourage everybody to take a look at the paper and give us your thoughts, feedback, engage with the content, engage with the guidelines, and hopefully we can have some interesting conversations about what needs to happen next. I'll pass it on to the panel to introduce themselves, and then we'll get started.
Thank you, Krista. My name is Thomas Eveson, and I'm the global head for the Sustainable Bond Opinions at Sustainalytics, Morningstar Sustainalytics, and been working and a member of the original steering co for the impact disclosure program that Aras set up, and I'm looking forward to the discussion. Thank you.
Hello, my name is Natalie. I'm the head of sustainability and stewardship for IPAC at Impact Asset Management. So Impact is a very specialized asset manager on sustainable investing, and we've been working with. Hello.
Did we have? Yeah. You have to switch it on.
Hello. Yeah, great. So, yeah, we've been working with suppliers like Sustainalytics and also like CBI for a long time. Thank you.
Hi, my name is Aras Matafar. I head up JP Morgan's Development Finance Institution, which is an investment banking function that has been specifically set up to help mobilize more capital towards the SDGs in emerging markets. And as Krista mentioned, I've also been co-chairing this industry task force called the Impact Disclosure Task Force. Has about 80 plus members across the buy side, the sell side, development banks, standard setters, international organizations, which again is there to set up now a market ecosystem to scale financing for the SDGs, and talk more about that.
Doing amazing work. I'm Sean Kidney, CEO of the Climate Bonds Initiative, NGO, the NGO for green bonds and thematic bonds, I guess globally. Now $5.4 trillion outstanding, was 2 billion when we started, roughly 2 billion. Also the NGO for taxonomies globally, which is guidance, which has become a crazy taxomania world. We'll get into some detail. and working a number of these parties with Thomas. You never made our event in New York, I don't think, did you? I gave you a ticket. He stood me up, so I'm feeling a little bit of difficult vibe here. We're going to get over it through the course of the session. And impacts we work with, but we've got to get you into our partner program next. So I'm outlining an agenda for my conversations afterwards. But the real issue is how we grow capital movement, and we're all active in that place, and that's an exciting conversation.
We're going to get to do the passing back and forth the button of the microphone. Thank you all. I would like to start with you, Ars, to put you on the spot, obviously. Talk to us a little bit about the task force, what it is, why it was set up, what can it do to grow the sustainable capital markets in different ways?
So the task force's aspiration is to create development finance as an asset class. And what does that mean? If I say, what is climate finance? Most people would understand that. They're like, well, it's anything that has climate impact, adaptation, mitigation. Thanks to the great work that people like Sean and Tom and everyone else on this panel have done in the climate finance world, climate finance has a definition. There's product around it. If you go to your wealth advisor and say, I want to put my retirement savings into climate finance, they'll give you some options of where to put your money, green bonds and other sort of instruments that does that. If you want to create development finance as an asset class, you need to first define what is development impact. How is it measured? How should it be disclosed? And then how should it be incorporated into investment allocation decisions? So that's what the task force first set out to do. We created a guidance that helps companies using existing resources. We don't want to recreate stuff. There's already a lot of information, SASB, GRI, ISSB is now putting things together, but how to navigate that information, contextualize it for the markets that they operate in. So to understand what are the KPIs that address the most acute development gaps in their context, what's the theory of change that links their outputs to the outcomes that are going to advance that, those development outcomes, set up a framework for ongoing monitoring and reporting, and put that out there into something we call a sustainable development impact disclosure. So creating this guidance for how to create an SDID is kind of the first building block of this asset class. But again, we can't just have this to become one SDID at a time. It'll take, maybe a decade to have the asset class. So then the second step is how do we leverage technology to already scrape existing information that's out there to pre-populate SDIDs for a large universe of entities that issue securities in the capital markets. So that's the second block, critical mass of SDIDs, which essentially creates a lot of more impact transparency into financial markets. The third step is now to have some sort of independent verification, some sort of assessments of these SDIDs, give them some sort of rating, some sort of score. So there's some independent evaluation of the quality and comprehensiveness and ambition and credibility of those impact disclosures. And then the last step is we could actually start having indices where having an SDID that meets a certain quality is a criteria for inclusion in that index. It could be across asset classes, the fixed income index, which is any bond issued by someone who has an SDID that is rated 3 stars or above. It could be an equity index, so on and so forth. And so the if we live in such a world, then if you go to your wealth advisor and say, you know what, I want to put my money into food security, they'll be like, yeah, there's a product for you for that. There's, a fund that is tracking, putting money into the equities of companies that measure and manage their impact on food security, have a credible theory of change for it, and have transparency and reporting on the outcomes they're actually achieving. And I'll not only give you, the return on your portfolio, but I'll give you some of those statistics on the impact that you actually created.
Thank you, Aras. Nana, from your point of view as an impact-oriented investor looking closely at emerging markets and have products that are associated with those regions already, what do you think about this aspiration? Does it fit within how you see those markets evolving and what your process currently looks like, and where perhaps are the biggest challenges for you?
Yeah, thank you, and thanks for having me. So Impacts is a investor that is trying to find opportunities from the transition to a more sustainable economy progress. So we've been doing this for 26 years. The company was founded in London, and now it's a global operator company. This year marks our 10th year of reporting on the impacts of our investments. So we've been doing this for a long time, and we try to help the readers, help our clients, as well as other other users to understand the social and the environmental impact of our investments. So I read your paper this morning, and I think it's pretty consistent with what we have seen. So definitely among the social and the social and environmental disclosures, environmental issues is much more, I think, taken care of by the current disclosures. And the other thing is there is more disclosures on the issues, but not the target setting. So when we are talking to our companies, we're trying to get them to set their targets on net zero and also on some other issues. We are part of the Net Zero Asset Manager Alliance. So 92% of our invested companies now have set their net zero targets. We are working on the remaining 8%, and many of the 8% is in emerging markets. So my coverage. And we try to understand what is the challenges they have, and also what is the way that we could help them to set the target, and also monitoring the progresses. And the other thing is when we are looking at the SDGs. So part of the report we do in our impact report is on the SDGs. We don't use SDGs to find the investment opportunities because that's not very easy. For us, it's not an investment taxonomy. But we do use that to map against our investments to see how our companies are doing on the SDG issues. And also because many of the SDGs are actually not for companies to work on. It's more like government actions, especially on climate actions. So it was difficult, I think, for us to use that to motivate our companies. But it's a useful tool to measure how they've been doing from period to period on the SDG alignments. Thank you.
Thank you so much. You mentioned a couple of keywords that I think Sean might be able to remark on, including taxonomies. CBI has just released an adaptation and resilience taxonomy as well a couple months back at New York Climate Week. And so we're starting to see this sort of expansion from looking in very sort of specific silos at climate mitigation as a theme into broader SDGs. Sean, what do you think needs to happen next in the market? And how do you see this type of work that ours is leading fitting into perhaps some of the work that CBI is doing?
So we need to understand the challenges to understand what we've got to do. The challenge we've been talking about at COPs now, ever since I've been coming, which is a long time, has been mitigation. But because of the failure of COPs and the failure of governments, we now have to talk about resilience and impacts. As you know, people are dying now already around the world from heat, from floods, from other kinds of weather influence, hurricanes in Florida. That's just begun. It's going to get severe very quickly. And that requires us to grow a resilience agenda, which is one thing. I do want to just flag a third agenda item that's important, especially for emerging markets. You know, the background of all of this is that 70% of the capex we have to do in, let's say, infrastructure the next 25 years is in emerging markets. It's not in the north. So, and the capital flows are not there yet. Now, they should be there because the opportunities are, but as Aslan will know, getting northern investors to understand the opportunity and have a little bit more risk appetite is actually really hard. It's really hard. The big pools of capital are in the US, Europe, Japan, places like that at the moment. There are pools in domestic markets and emerging markets, like in India or even Zambia, which can be mobilized. And there's work to be done. We've got to do both sides of it. The third thing just to bear in mind, which is an overarching theme, is that we have had some success the last few years. Governments have started to act. There are policy green lights everywhere around the world. And that's especially in China and Europe, and now in Japan and the US. I don't think those key policy green lights in the US, the IRA, are going to change for a variety of political reasons because they're already making money in Republican states. So we won't see Elon Musk allowing the Tesla revolution to be pushed aside by Donald Trump, for example. The green revolution globally is well underway. Cheap solar panels from China, for example. These are all because of state action. Tesla, by the way, was funded by the US government to $1 billion in its early days, etc. All of these things have been driven by state policy. There is an opportunity revolution coming through. Emerging markets need to rethink their national development plans to take advantage of those opportunities. But just back to resilience, which is one of the things you need to be thinking about as you're looking at opportunities is how to ensure you can survive the shocks that are now becoming normal. We published a resilience taxonomy, which is a guidance. It's 1,400 areas that we need to look at to understand what are the investments we need to make in the future to qualify. The way this works is, for investors, this is guidance to lower default risk. This is guidance to better investments going forward that perform. This is guidance for what gets included in the green market once we go beyond mitigation. Now, I've said included in the green market. We've been very successful at going a green and thematic market, which is about $5.4 trillion outstanding nowadays. Massive growth. It's liquid. There's a huge investor appetite. Last month in Azerbaijan, the first green bond ever issued in Azerbaijan came out. It got 170 basis points greenier, cheaper interest rate from Azerbaijani investors, not from French investors or American investors. This is really happening everywhere, right? So we want to take advantage of that. We don't want to say set up a new silo. So I don't really agree with your language, Arslan. I don't want a new asset class. I want an extension of an existingly successful asset class rather than a new silo. So, I realize that's not quite what you intend, but let's think of it as a subset of the existing big market. In that subset, we've seen a lot of other work already. We've already seen a transitions market. We certified the Japanese sovereign when it came out this year because it's not separate. It's got to be part of the existing market. Japanese transition bonds can fit into a green portfolio that meet 1.5. It's a different flavor of gelato, but it's still gelato. Resilience bonds are the same thing. Gender bonds are the same thing. When we talk about resilience, we don't just talk about physical hardening of infrastructure. We talk about the social investments that will create more resilient societies so we can bounce back the next morning. The economic investments that will create greater wealth in emerging markets so they can better deal with the crises that are becoming normal. Nature-based investments that make sure our natural systems are stronger and can survive a crisis coming forward. That's what we're talking about. Extending the existing market. With the help of Sustainalytics, we have already helped grow an incredibly successful market. We just got to do more of the same, knowing that investors want more of the same. They like the green thing. It's working really well. For some of the biggest US investors, green bonds have been the most successful ESG marketing strategy ever. It is a marketing strategy, but that does not to lessen it, because what it's about is understanding and clarifying what qualifies. Discovery of what's there, making sure that the reporting and transparency works is part of what we need to do to build confidence. Discovery of what could be, using things like artificial intelligence, helps us more quickly find solutions. And that's why Krista's work is so important to this broader agenda.
Thank you so much, Tom. We've been set up nicely here. Morningstar Sustainalytics provides, among many other things, second-party opinions on labeled all sorts of gelato-flavored bonds. How do you go about interpreting quality in the system and trying to help make decisions about what good looks like effectively against this backdrop of all these different, sometimes competing priorities around mitigation, adaptation, resilience, and the SDGs, which obviously overlap quite a lot?
Thank you. I almost have to go at a higher level because these are very big questions, and how do we address all of these things? I really want to take a few feet above this whole industry and look down on it as this initiative, as what Krista's company is doing and what we do at Sustainalytics and at CBI. It's all on the same thing. The first green bond, as far as capital markets history, was yesterday. It was only a few years ago, and it was a relatively straightforward concept. Let's do a bond to invest in impactful renewable energy, and companies like Sustainalytics were called on to say, could you just verify that this is credible and impactful and that it would basically qualify as green if and when issued and when put to work. We have come a very long way since then. It took us 5-6 years to get to 500 opinions. Now we do that every year, and it's growing and growing and growing. And as we're saying, we're now looking at transition. We're looking at blue. We're looking at gender bonds, but it's all the same thing. We're assessing the credibility of the claims, the credibility of the commitment to review what the money will go to, a commitment to reporting, and a limited level of transparency. Transparency was easy when all the money is going to wind farms, and in 2 or 3 years you can say, look, the wind farms are up and running, they are into the grid. But what I've noticed, and here at COP, this COP more than ever, when I began, most of the conversations were in Western Europe, certainly Northern Europe is a hotspot for this. North America, despite all the rhetoric, as a country, the United States is still where most of the green bonds as one country are coming from. But we started to see more emerging markets creep into the conversation. We started to have more conversations with development banks, with their loan programs and their bond issuances that they're underwriting focus on emerging markets. And if the headline here, we kicked off with 160 billion, or is it 60% increase and 120 billion by the multilateral banks. That was a lead headline, but there were countless other similar announcements by regional development banks, by bilateral national development banks, asset managers, asset owners, etc. That quadruples that at least if you add it all together. So what we see is, and as we go into transition, what we're looking for is credible with a plan. There's transition is a focus now, and this is going to go back to emerging markets in a second. Transition is a focus of a lot of companies. Because again, we've moved away from strictly pure play solar and wind, and we've gone into steel and cement and plastics, and every industry under the sun is now looking to utilize or leverage sustainable finance. Horribly absent from all of this is the developing sector, completely. And we've had 5, 6, 7 days of reasons why. But even in the sustainable finance world, we have controversies in some areas that might make it difficult to apply that to a certain sustainability linked leverage. But taking all that aside, this initiative, which is impact focused rather than just green or social, is fantastic. It doesn't contradict any of the set established taxonomies, the EU green bond standards that are in the works, the EU taxonomy, etc. All the same principles, green bond principles, it's all there. Commit to something that is credible, commit to oversight and governance of that, commit to transparency and reporting. That is basically the principles that govern this. And where we've, again, fallen short, and every announcement, hall to hall here, in every panel, one of the recurring themes that I really picked up on this year, it's a quote, if you look on LinkedIn, I've been saying this a little bit, we're moving away from intent, pledges, to outcomes and impact. That's inevitable, but that's not greenwashing and it's not avoidance. It is an evolution of this industry that went from one bond a few years ago to 5.4 trillion outstanding. We're now at over 30,000 issuances, or almost 30,000 individual issuances out there. We're at critical mass. We're making a data leap ahead of regulators so we can have a relative performance comparison of the bonds outstanding. It's coming. And as the disclosures increase, post-issuance disclosures, the guidance of impact, even the EU green bond standards have recommended if you're coming to market with a green bond now, you better be saying what the impact you're going to achieve is, and you better be reporting it independently verified every year. It hasn't been avoided, it just hasn't happened yet. And a big part of that will be the technology jump that we're experiencing here through AI, because all of this is in documents and in many different silos of data sets, as everyone in our industry has been grappling with in the green bond industry to be able to track and manage this. So I think this is great, and it's focused on where it should.
Thank you, Tom.
the technology piece is obviously interesting. We work on it a lot. You'll see that in the paper. If you visit ClimateAligned's website or talk to me after, we can have that conversation. It only gets us so far, right? We can surface what exists, but then the hard yards are engaging to fill the gaps that remain, right? And we've talked about the bond market. I want to bring it back to Nana because I know that some of your EM strategies are quite equities focused. So you really talk to these companies to say, okay, this is what we're seeing, but in order for us to continue investing in you or start investing in you, this is what you need to be showcasing. Can you talk to us a little bit about what that really looks like? Because we have this conversation all the time. There's no data in emerging markets. It's really, really hard. You've had quite a successful, track record to do that as an investor. What does that look like, and what are some of the outcomes that you've seen?
Thank you. First of all, I want to say, so far we have 100% of our AUM in APAC on public equities, but actually we are developing fixed income starting this year. So we're looking to try to make it 50-50 on global basis, and also looking at some bond issuance related to APAC market as well. Back to the equity story. So Impact has been doing this for over 20 years, and we have a policy that we engage with our target companies one-on-one before we make the investments. After we make the investments, we also talk to companies at least once every 12 months. So we are very active, very concentrated, long-term investor. Average holding period is about 5 years. So try to really, through the engagement, to make the changes. I want to say that, I think at this stage, it's not that we don't have much data. I think in some markets, actually, we have too much data. I think the issue is we need to have meaningful disclosures. So there's lots of compliance-driven disclosures around the world. Many of these companies, they are actually multinational, although they are domiciled in APAC. So they do follow sometimes EU standards or the coming SEC listing standards when they're disclosing the environmental or climate-related disclosures. However, when we are looking at the actual text, it's not easy for us to sometimes to get the substance of how they've been doing. So there comes the very important part of our work, which is active ownership. So the biggest chunk of my time is to try to talk to our companies and to understand how they've been doing on various of the issues. Environment and social, two issues that we've been focusing a lot in the past. Just in this region, we also do a lot on governance because governance really sets the tone at the top, and we want to make sure the culture and also from the top management, the involvement is there for governance on the sustainability issues. So we have a system to track record all the engagements we've done with any company, and we share that almost quarterly with our clients and also with other stakeholders if needed. I think two difficulties with this market is, one is sometimes it's still difficult to get access to the right people. So a lot of companies still doing capacity building. When you talk to IR, when I show up with our analysts, and when we talk to IR, and they said, oh, actually, we also have this ESG person, and we talk about some ESG issues, and they suddenly say, oh, I'm not the person to answer your question. We have to defer to another department, and they don't normally talk to investors. So that is still sometimes the case that we face. And the second thing is when we talk with companies, it is not easy for them to sometimes understand where we're coming from and why it's not enough for them just to do the compliance standard. So I think we need to spend some time to explain that to some of the companies. Thank you.
Thanks so much. Aris, JP Morgan overall, and obviously the development finance institution specifically, also engages a lot with companies across APAC and broader emerging markets and developed markets too. Can you talk to us a little bit about what that looks like for you? Do any of the issues that Nana's just alluded to track with your experience?
Yeah, so let me talk a little bit about the context that we normally do this. It's typically during a fixed income issuance, and just to put some numbers on the table, every year there's about $25 trillion that are raised in the capital markets. Of that, about $1 trillion comes from equity issuances, 24 trillion from bond issuances. So very big asset class. I think the green bonds, as Sean just said, 5.5 trillion, very, very big achievement in mobilizing finance specifically for capital, for climate finance. However, as Tom, you mentioned, If you take China out of the equation, less than 10% of those green bonds are being issued by emerging markets, right? So there's some structural reasons why some developing countries can't issue these green bonds, and some of that is because the smaller ones, especially, don't often have a pipeline of eligible expenditures that they could dedicate to purely green use of proceeds. Or they might be infrequent issuers. They come once to the market every 2 years. They need to be able to finance their entire budgets, and they don't want to just limit themselves to certain expenditures, or they might have capacity issues and whatnot. So, and I like your term, Sean, the extension that we try to bring to the fixed income market is to say, for especially emerging market issuers, if you meet a standard of impact measurement and management of your overall business, of your overall company strategy, your 5-year plan, take your vision 2030, analyze what are the impacts associated with that, set targets, commit to monitoring and reporting on those that are most meaningful and material. So we help them with that materiality assessment. What is it in your context that will move the needle on actually addressing the most acute development gaps that are unique to your market? It'll be different. If it's your same company in a different country, it'll be a different set of targets. But if you do that, not only will that help you manage your business better, so you're not just managing it for profit, you're managing it for impact, but it will help you with your investor engagement and investor outreach. And it's been proven to be able to crowd in additional capital into their, general obligation bonds, because they now know that the general corporate purposes of that company is now being measured and managed for impact. And we've assessed that it's about 20% additional investor demand that we're able to crowd in for clients of ours, that we advise them on how to put together one of these development impact disclosures and management frameworks, and use that in marketing to investors. And again, hopefully we've done a little bit of the analysis. We've done about 70 of these to date. And the whole idea of now codifying this into a guidance and sharing it with the market is that if this is replicated and by other banks who are in our task force, Bank of America, Standard Chartered, Deutsche Bank, if everyone else is kind of replicates what we've been doing, this could add $200 billion of impact and sustainable investment opportunities in fixed income to the market per year, right? And so within 5 years, it could be $1 trillion asset class, and again, an extension to the existing sustainable fixed income market.
I just saw Sean taking notes furiously. So did you want to respond to any of that? Okay, great. I want to go back to you, Tom. From Morningstar Sustainalytics perspective, looking at the expansion of the market, can you talk a little bit about your second party opinion model and what that engagement with these issuers of these sustainable securities looks like, and the challenges or opportunities as we expand and extend the investable universe, and the sort of potential flavors and themes and these more context-specific targets and impact outcomes that Ars was mentioning just now?
Of course. So the engagement has also evolved into something a little bit more intensive as we've moved away from, or moved out of, and evolved past straightforward, highly recognizable green industries like renewable energy, for instance. And as we get into hard to abate, as we get into chemical companies and everything, the conversations to back and forth as to justifying why this is a net benefit impact. That's what we're always looking for. We're trying to get to our own conclusion. We have our own taxonomy, which goes through, which has been, it's a massive document now because it has to cover every use of proceeds in every kind of sector and activity that we've come across over the last several years. And we hear a lot of good claims, but we really spend most of the time aligning with green bond principles, ICMA. Will you report? Will you have a framework? Which is really what we're assessing. I have to say is relatively straightforward. Here's the framework. We're assessing it. Well, then you've got one. Is it good? Is it comprehensive? It's getting to the net benefit. And as we get into more and more industries and sectors, that gets more and more complex to decide the net part, because you can always have something that is good or adds a service that is not doable. But we look for intentionality, we look for additionality. Is this solving a problem? Is this improving a problem rather than just servicing? I've had many companies, I remember, that come saying, but if we don't do this, no one else will. But you're not helping to change the situation. If there's a disadvantage or region or an isolated challenged population that can't get access to essential services, simply providing it, but then charging accordingly because of the excess risk does not change that situation. We need to see that there's work in progress to make this easier and to not make that population so marginalized in the first place, whatever that population is. So that's the kind of work we go through. And as we get into more and more out of the green sector into the more hard to abate, that gets more and more complicated. I can reduce emissions, but what am I doing on the other side to be able to do that? That becomes a big debate. And I want to point out with all of this, I think it's two points I really wanted to point out. This lack of disclosure or transparency. I never thought this would be something that was so relevant. But this is actually the second time I've been with Morningstar in my 30 plus several years career now, because Morningstar started, and I was with a startup in Canada that became Morningstar Canada 30 years ago, started tracking mutual funds. There was no more disclosure or transparency and available data at that time. As mutual funds boomed, they were all the best fund you could possibly invest in. And all you had to do was ask them to verify it. And they had all of the great information as to why they're great. They would not disclose their top 10 holdings. They had nowhere to get that information. They would not disclose who their portfolio manager was, who was on the team. And this data began aggregating long before the regulators stepped in, and Morningstar started to track it and rank it and compare it. And then you could start to say, well, you said you were the best fund, but if I line you up against other funds, you're probably second from the bottom. But you couldn't do that before. And here in impact and sustainable finance and bonds, the same thing I'm watching almost word for word is happening again. And I don't mean it in any intentionally negative way. Just it's building. We have critical mass. You wouldn't have wanted to spend all of this time and effort developing this for 1,800 bonds that were generally illiquid and held by NGOs and multilateral banks. But you do now that we have a massive market at 30,000 plus bonds. So this is where the data is coming from. And it's where a lot of the greenwashing will disappear in the transparency with or without regulation. And I'll add that with our Morningstar Sustainalytics, we launched the low carbon transition ratings. People want to know, well, how are these transition plans moving along? The data is not all actively available. It's not like all these companies, public companies, are saying, here's all of our transition documentation and reporting. But it's being found through AI, through a lot of technology advancing, and then you can start to line these companies up and say, you're all transitioning, I get that, you all have great targets, but actually there's a ranking, and that's coming, and I think that's very exciting for the finance side as well.
Thank you. Sean, I want to switch tracks a little bit because someone mentioned the magic word of additionality. Maybe it was Tom. There's this debate within the sustainable fixed income market that has been had for many years about whether green bonds and other labeled bonds are actually additional. There's some market specific dynamics around bonds being a refinancing mechanism and so on and so forth. But I wanted you to talk us through a little bit of why CBI started and what the actual success of the green bond market has been, because we're now at a stage where there's, as stated before, there's this taxomania, there's 40 plus taxonomies either in place or in development in different jurisdictions across the world. They're being used in different ways, but it's starting a conversation that didn't exist when Sean and others started CBI in
9 or 10, something like this. So can you talk to us a little bit about what that success has actually been and then what happens next?
We have a crisis of short-termism over long-termism. Arslan's colleagues in JP Morgan are stuck on short-termism, 3 months commission payments. Their clients are saying they've got to make money in 3 months or 6 months. We've seen executives in the US captured by 6 months to 3-year returns. It was a horrific study 10 years ago, horrific from my perspective, of CEOs, the top 500 companies in the US, which essentially said, if you had to sacrifice 6-month returns for improved 3-year returns, or sacrifice 3-year returns for better 6-month returns, which way would you go? Yes, better 6-month returns at the expense of 3-year returns. This is the lunacy of the society, the economy we've constructed, that we will destroy nature to make more money tomorrow, that we won't invest in our societies because we might get better profit next month. That's what we're dealing with. That's why we have the climate challenge. Our scientists have been telling us for so long, 30 years, 150 years, if you look at the first papers around climate change, that this is a problem. We have failed to act because we are caught in this prism of short-term action. What we've been trying to do is to bring at least a possible power block to bear in that equation, in these arguments that happen in the corridors of power. Institutional investors are by mandate, by fiduciary obligation, by legal requirement, have to have a long-term perspective because they're required to pay your pension funds when you retire. So they're more concerned about matching assets and liabilities over the longer term, at least in theory, than they are about making profits next month. I mean, they've got to do a bit of both, but it's a better balance. So what we're essentially doing is trying to bring a different understanding of the nature of risks involved in meeting the legal mandate of something that we have, without necessarily understanding what we're doing, successfully done in the last 70 years, which is globally create these large pools of capital, $130 trillion of them, which are long-term in focus, pension funds, insurance funds, sovereign wealth funds, if you like. That's the game. All investment is about a balance between opportunity and risk. All of it is an opportunity, is a balance of horizons of opportunity and risk. We're kind of saying pension funds, and it's working. That's why we have this appetite for investments, that you need to be looking 5, 10, 15 years out. Well, trying to weigh to bridge the two issues. In the opportunity space, in mitigation, we've successfully built a narrative that frankly was not there 15 years ago. That investing in mitigation and green energy is an opportunity. In the green bond space, when we started, all investors said, oh, I'm not sure about green bonds. I'll have to pay more, won't I? I mean, it's not going to be good an investment. Nowadays, they say, oh, it's a better investment. And the numbers are telling us. The Brazilian sovereign, when it came out last year, green bond, got 150 basis points better price than the ordinary sovereign because investors decided it was a better investment. It was lower risk. In the resilience taxonomy that we're rolling out, which is where we overlap with the work of the JP Morgan Development Finance Institution. It's about identifying investments, especially in emerging markets, that need to be understood as lower risk. If a municipality like Cape Town is investing in water investments that mean it's going to be better able to survive the droughts that hit Cape Town now more often than before, it makes Cape Town's water municipality, and frankly Cape Town, a lower default risk for investors going forward. We need to apply that. We are applying that to social investments, to nature investments as well. So the future is absolutely understanding longer term risk. The future is long-term investors becoming more aggressive about explaining to governments why they want them to take action on these issues, because it means lower default risk. Because if I invest in an Egyptian bond and Egypt finally does something on climate resilience, that's going to mean I'm more likely to get my money paid back and pay your pension when the time comes. That's the storyline of this whole equation. And it's also, by the way, going back to my third pillar I mentioned earlier about green revolution opportunity, the storyline for investors is that where is growth going to be? If it's managed properly, it's not going to be in the US. It's not going to be in Germany. It's not going to be in Japan. It's going to be in Nigeria. It's going to be in India. It's going to be in Indonesia. That's where we need to be looking to ensure we can pay your pensions in a few years' time, to ensure we get the returns subject to those countries taking the steps to be resilient. If they don't take the steps to be resilient, frankly, they're not going to get the money. They're not going to get the growth. They're not going to get the jobs for the citizens. They're not going to get the future for their kids.
Can I add something? So I completely agree with all of your points, but I just want to add a little bit on the first point you mentioned. I'm not a spokesperson for all of JP Morgan, let alone for all of corporate America. But but I agree that there is definitely short-termism in our economy. I also think that we can't paint everything with the same brush. There are differences between some companies that are more short-term, in their thinking, and some that are less. Even within a company, there are people, change engines within those companies that are more maybe longer term thinkers and more care more about non-financial outcomes. And the benefit of everything we're talking about is to be able to connect those people with investors like Nana, who also cares about impact. And when the two meet and the two are empowered with the right data and information, and the two are able to not only partner in financially but also intellectually, then good things could happen. But if then you don't have that transparency, and you don't have the channels, you don't have the instruments, you don't have the mechanisms, you don't have the independent verification, then the two will never meet and the change won't happen. So that's, I think, what all of us here at these COPs, you get all the like-minded people together, and then hopefully good things could happen.
Completely agree, and it would be remiss of me not to mention AI in this context, given I run an AI company. What we're trying to build to help with all of this is effectively, we will always disagree on the scope, the scale, the pace of change, the specific interventions. This is why we have not one global taxonomy, but so many, because this is a political debate. We will also have different opinions within the financial institutions, both on the buy side and the sell side, and the service providers that are trying to help this ecosystem to grow and become more efficient. We will not agree. So the AI piece for us, from ClimateAligned's perspective, and we work across all of these sectors, all of the stakeholders within the sector, is effectively a translation machine to say, we can help you lift out all of the stuff that already exists from any kind of messy, unstructured data sources, and say, against your worldview as it stands today, with lots and lots of computing power, this is where we stand. So the debate moves from anecdotes to actual data. And we can spend more time, all of us in our different respective functions, to try to plug those gaps and have those debates about how short-termist are you in corporate America, where you should be directing capital to emerging markets, and so on and so forth. Thanks to all of you for joining us. And we have about 5 minutes left, so I wanted to open up the floor if you have maybe one or two burning questions for any of the panelists. Just to say thank you for taking time out of a busy COP, but these are, in the audience as well, the people that are doing all the hard work to try to make this thing go faster so that we don't self-destruct in this century. Does anyone have a question? Please raise your hand. No? Yes, okay, Paul.
Thanks for this interesting discussion. Private financial institutions are saying that there's a lack of bankable projects in the emerging markets. Could it be that there is a overestimated perception of risk because of a lack of data in those markets, or instead of just a lack of projects pipeline? And could AI help us solve this increased risk of perception?
So the lack of pipeline usually comes from the fact that, there are ideas of projects to be done, but the actual feasibility studies and the details of those plans have not been done. The offtake agreements, if it's, a renewable energy project with the grid, on how much, they're gonna buy the output and how it's going to then pay for the project isn't there. The legal agreements are in place. So there's a lot of upfront cost, and it usually requires a lot of capital to be spent to be able to do those studies and to get to a bankable project, and those simply just are not enough, and therefore those efforts, and actually Tom, you can speak about this, I know you've been involved, that are kind of doing that first mile of figuring out those feasibility studies to get to a bankable project. Very, very valuable. It's something that the private sector is saying, especially the public sector development banks, should be spending more money on, because they have the experts, they have the people on the ground, they have the capital, and actually their money could go have a much, much larger multiplier effect if they spend a little bit of that first mile money into that technical advisory to do those feasibility studies, because once it's done, then often the private sector could finance it. And I say could because I think there is still an issue about the risk. The risk might be overestimated, but we don't know because there's just not enough data to know whether you're estimating it correctly or not. Now, the World Bank just released the GEMS database, right, which shows the probability of default and loss given default of development bank loans. However, that's not easily transferable to the private sector because all of those are development bank loans, so they have this preferred creditor status that is not one-for-one transferable if it was just a bilateral loan from a purely private sector entity. So if there was more information sharing or availability, and maybe AI can, and maybe our AI experts can talk more about that, to make that more information more transparent, then definitely risk models can be updated. I think there's a hypothesis that there's an overestimation of risk, but again, I think some PhD people in the audience can also maybe do a study on that.
Lack of deal flow in emerging markets. Andrew Johnston, put your phone down, come into the table room here. Is there a lack of deal flow in emerging markets? Andrew Johnston runs Climate One, which is an investment fund investing in emerging markets. Tell us about your Jamaican story, for example. Come on, you're on stage.
All right, so the answer is no. Answer is absolutely no. There's lots and lots of deal flow in emerging markets. Well, I'll suggest. So no, there's lots of deal flow. The challenge is actually what represents bankability. And so there are two terms out there which really frustrate the entire flow of capital. It's this definition of bankability and this other word you keep on hearing out there called shovel-ready. And the gap between what's shovel-ready and what's bankable is so broad at the moment. Now, the way to fix that is both to enable early stage developers to get to something which is a little bit beyond shovel-ready, but also most importantly to redefine what bankability means. And bankability unfortunately means the deal that the credit committee approved yesterday. And the deals we need to do tomorrow are definitely not yesterday's deals. So therein comes blended finance, different types of credit enhancement instruments, access to market through bonds, things like that.
And the role of Climate One.
This is a lovely place to end the discussion. I feel like we could probably have another panel discussion with Andrew just about this, but I am afraid that we must let the next session commence shortly. I'd like to thank the Digital Innovation Pavilion again for hosting us today, and our partners over at Evercity and all the other hosts and sponsors. Thanks, Andrew, for hopping in. Thanks, Sean, for doing the Sean thing of calling out people in the audience. If you go to any of his talks, this is his recent MO. And thank you to the audience and the people
tuning in online, for joining us. Read the report, come talk to us after, and wish you a successful and productive rest of COP. Thank you.